Howdy Monday. It is coming at you live. Coming at you live from Inside Production Studios here in Phoenix, Arizona. My name is Robert Morales from Monday Market 15, the 15-minute show that takes roughly about 30 minutes. So bringing you most up-to-date information about the Phoenix market, residential real estate, all the good stuff about houses. I'll be taking questions as we go along on the broadcast. Just add them in the comments section below. I'll try to get to them as we go along. If I can't get to them, I'll get to them after. If you leave the comment. But be sure to hit those heart emojis because I love the loves. And if you're on YouTube right now, hit the subscribe button because I appreciate it when people follow and listen to every single word I say. Whatever that means. So it's Monday. It's crazy. I got a lot of screens up as usual, and I'm trying to decipher what to start with first. But I figured, why don't we start globally, to kind of figure out what's going on with the bigger market, and then drill down kind of to the Phoenix. We'll touch upon that a little bit and try to stick within 15, but it'll end up being 30. Okay. So the big thing today. So the bond market. Does anybody know what bonds are? Bond market. No? Well, they're acting kind of weird. So I'm going to go ahead and put that up here. The bond market's weird and scary breakdown is still a riddle. From 1 year on, we're far from getting to the bottom of the bizarre spike in the treasury yields. Oh my gosh, what the heck does that mean? So for the layman people out there, and I would call myself fairly layman too, the bond market does impact, us in residential real estate based upon the 10-year treasury. So to kind of give you an information on what the bond market is, I pulled this up for you guys because I like to be informative. This year, the bond market is where investors go to trade, buy, and sell debt securities, predominantly bonds, which may be issued by corporations or governments. The bond market is also known as a debt or credit market. Securities sold in the bond market are various forms of debt. How that's important? Well, it's important when you have the Fed basically telling us they're going to keep interest rates low, so they're near zero. And but the one thing the Fed can't control is the bond market. So the bond market right now is wonky, to summarize, and that's definitely pushing up, the 10-year Treasury. How the 10-year Treasury affects, interest rates is significant too, because that when the bond market has concerns about the way the markets are going, stock market, the economy, they tend to want to get paid on those securities. So if you owe a credit card, for instance, and they charge an interest rate, so the credit card company is going to want its money. They lend you money for, in order to gain more money. So every $100 they lend you, they're going to charge you, anywhere from 12 to 15%, maybe sometimes even 20, because they want to make money off of you making money. And so it's debt. So the bond market is debt. So how does a 10-year Treasury affect the bond market, or affect treasuries, affect us buying houses? Well, I have that too. Why do Treasury notes affect mortgage rates? When the Treasury yields rise, investors in mortgage-backed securities demand higher rates. They want their compensation for greater risk. The bond prices affect mortgage rates because bonds and mortgages compete with the same low-risk investors want a fixed return. So basically, the bond market is like a big turtle. It's not sexy. It's not crazy. It's nothing. It's not gonna charm you in any way. I mean, maybe initially, like, oh my God, it's a big turtle. But when it does something significant, that's when you take notice. And that's kind of where the bond markets are today. With the bond market, again, the Fed does not control the bond market, does not control the 10-year Treasury. And despite every best effort, it can't control the way the 10-year Treasury is running. So I'm going to go ahead and pull those current numbers up. So from the beginning of this year, you can kind of see here on this chart, the 10-year Treasury has just been rising. And right now it's currently 1.73. And how that affects you, how that affects lending and your ability to borrow money, it impedes in your ability to borrow money. I guess the simpler way to do that. So the rise in the 10-year Treasury will also increase your interest rate, will also increase your ability to borrow money for a home. So I'm going to go ahead and show you. Again, you can kind of see here the 10-year Treasury has gone up since January up to about 1.73 currently. Here, see how that affects you directly. I have this as well. So I pulled up interest rates. I kind of just played with some numbers. I got on some sort of website to kind of show you interest rates. And for somebody for her in the zip code, the Phoenix zip code, a property roughly $365,000 in value, which is the median price point here in Phoenix. Loan amount's going to be $328. I believe that's on a 5% down payment. So if your credit score is in the mid range, about 680, that's about a conventional loan. A lot of people are in the 640 range. You know, if you're in the 640 range looking for a 30-year term, you're looking just above 3%. And, you know, about 2 months ago, we were running closer to, you know, below 2.5, 2.25. And now we're more into the three and a third. Oh boy, it's Monday. 3.5, 3.14, 1.24. 3.2. Again, if you're in a little bit better credit situation, like in your 720s, that rate's going to decrease a little bit, but it's still hovering around that 3%. So again, a significant rise in there will tend to not qualify you. If you were on the edge about 2 months ago, as far as like buying a house, being able to qualify, your chances are this last 30 days you're not going to qualify. You know, it's just that simple. Just because that about a 1% rise in interest rates. And again, this is just off the internet. I'm not a lender. I don't manage rates. I don't know any of this stuff. I just bring opinions. I'm just a YouTuber guy bringing information. You know, but concerning information regarding this housing market. So as the bonds in the bond market or the investors in the bond market are a little bit more concerned, they are going to elevate those interest rates, the 10-year Treasury rate, which will elevate our interest rates too, which is what's happening right now. So what will happen in this, again, you'll have more disqualified buyers. So if you're in that FHA program, I'd be a little bit more cautious in there. Talk to your lender about what that looks like for you. If you're on, if your credit score is a little bit lower, obviously, again, talk to your lender what that information might be regarding your ability to purchase. And let's see, what else do I got? So that's on a global level. What else did I have today? I had a lot of stuff. So directing it back to the Phoenix market. Oh, look at this. I found this too. This is more of like a side note. So as people are moving out of New York, look at Jimmy Fallon. Jimmy Fallon's leaving New York. He's selling his house for $15 million. So if you guys are interested, there's a $15 million house in penthouse in New York available for sale. I thought that was interesting. But anyway, I digress, and I go back to what we're talking about. So addressing back to the Phoenix market. Unemployment is wavering. It's getting a little bit better, as you can kind of see here in January 2021. February numbers aren't quite in yet. I would hope that's going to decline, which means you have less unemployed. I am optimistic as more and more restaurants around here open. I mean, for some areas, it didn't even seem like we had a pandemic with the number of people going to restaurants. You know, whatever your experience is here, but I'm hoping the unemployment rate does decrease a little bit. The cost of goods in the local Phoenix market is on the rise. I mean, food at home has gone up 4.5%. If last year, if you didn't get a pay raise more than 4.5%, you're paying for it in your food. Housing is up 2.7%. So if you get like a 1%, 2% raise year over year, you are not hedging inflation. Inflation's ahead of you, and it's so small. I mean, it's going from like a cup of coffee at Starbucks for $2.50 to $2.55, and it seems like a small expense, but given everything that you have, if you work off percentages, it's a significant rise, especially if you're not increasing your income. Housing. The one thing I did find here, look, apparel. Look, apparel is down. Time to go buy some clothes. That stimmy check. Go buy some clothes. It's on a discount right now in Phoenix. So the local areas here, again, unemployment, I'm hoping is going to be increasing, or I should say unemployment decreasing, employment increasing. And and we start to see our economy. I mean, like I said, I think Phoenix in and of itself has been fairly lax regarding kind of mask mandates and what they do. I mean, overall, I mean, we're not California by any means. I mean, we weren't shutting down, for an extended period of time, rolling shutdowns or anything. And I think we're going to have a better bounce back regarding that. And again, in some areas of town, I live close to downtown Gilbert. You would never have thought there was a pandemic. It's just crazy. There's people out there shopping and doing stuff what they need to and getting in fights over masks and stuff. It's kind of crazy. So I also wanted to kind of show you the market index a little bit too. The market index, this is something I pointed to last week, something to kind of watch out for. This market index, this demand index is kind of interesting. It's yellow means balanced. So to go over it, the demand index is still high, and we don't want it green. We want it yellow. That means a more balanced market. The more it goes into the red, the more it's unbalanced. The more there's less demand. So we want to hit for 100 on the demand index, and we're kind of wavering. Last week when we looked at this was just a hair higher than this. And I think the demand index is going to continue to decrease with that treasury rate increasing. So we're going to see a little bit less demand, but it doesn't really matter because our supply is so minute. Again, green means, and green doesn't necessarily mean good. Green means that we have less supply. A balanced market is in the yellow. We want yellow. Red means we have no supply, or we have too much supply, I should say. But green means we have too little supply. So even though this demand index is decreasing, we still have such small supply in our Phoenix market. So that's something to kind of watch out for. Last week when I was looking at that, like I said, it was a little bit. I was concerned that our demand index would be decreasing, which it still is, and with those treasury rates increasing, I see that it's a continued trend here in the Phoenix market. Globally, again, concerning. Let me throw this up. So February saw a decrease in home sales, which is, again, optimistic for, those buyers out there. But if you read the article, you'll see that there was a drop in home sales only because of the low inventory. So as Phoenix goes along, as we're having challenges with the supply, we'll still see a large competition with those limited supply that we have out there. Let me see, what else do I got? I think I might actually be wrapping up early, which is amazing. I never do. I'm checking one last couple things while I'm here with you guys. So an interesting thing, I did want to mention it too. I think, and again, this is an opinion. I'm just bringing information. There's a million other guys out there with different opinions about everything, and I'm just one of them. So my concern with the bond market the way it is, the federal government, where am I at? Oh, let me get that. So the Fed is purchasing large amounts of mortgage-backed securities. I pointed this out a couple weeks ago, and as you can see here, this is 2 million of millions. See this dollar, millions of dollars, 2 millions of millions. So whatever 2 million times millions, whatever number that is, that's how much the dollar figure in mortgage-backed securities that the Fed is purchasing. So what I believe they're trying to do is give that bond market a little bit more security and not doing everything they can so that the 10-year treasury isn't inflated or isn't increased in any way. I think they're trying to control for that, and that's why you see such large purchases of mortgage-backed securities. I could be wrong. I don't know. I'm not an economist. I'm not an analyst. I just kind of see things, what's going on out there. But I mean, that's kind of what's happening in predictions. I mean, we're still kind of in a weird spot in Phoenix because of our tax brackets, because of our the way our economy is structured. We don't have a whole lot of jobs out there. There's some good. There are some good industries that are here in Phoenix, but the overall market, I don't believe the income levels do support our current house prices. So there is going to be some tremendous shift there. I don't know how that's going to shift or how that's going to play out. I can predict, I think a lot of people are coming from out of town. A lot of people that do have a job, from Illinois or California that are getting paid a higher wage are coming out to Arizona because they can work from home. But that's, I believe, soon coming to an end. And how that manifests out and how that changes our local economy, I don't know. Because if something happens, and I give this scenario all the time, if something happens in Illinois, and I'm an employee for XYZ company in Illinois, I'm getting, throw it out 100,000 a year. But as people leave that local economy out in Illinois, Chicago, whatever, they're going to come out here, live out here at a lower tax burden and remotely, and the local economy over there will dry up and collapse at some point. Because people are leaving those high tax bracket areas, and when and if those local areas over there, Chicago, Oregon, wherever they're from, they start drying up. Excuse me. Those areas start drying. Those companies dry up. Where they move out, they may decrease their employees. They may get rid of those people who are working from home. And when and if those people that came out here to live because it's just cheaper look for jobs out here, the economy doesn't really support that. I mean, the amount of money you would make in a different state doesn't necessarily equal to the amount of money you would make here. Again, the economy doesn't support that. So with all that said, I think with the number of buyers that are out there, the 10-year treasury increasing interest rates right now, I think we'll start to see a decline in buyers out there, at least qualified buyers. So there'll be a little bit less competition. You won't see it. I mean, I was out house shopping this weekend with Violet. We went to an open house and there was a line. There's still lines out there. There was a line of like 10, 12 people all just waiting out in the park because they were only letting like 1 or 2 people in. So there's still buyers out there. There'll be maybe less, whatever less is. So as the interest rates increase, you'll start to see people disqualified and be able to be able to purchase a home. So the competition may be less. You don't see it. I just received an offer today in one of the listings that I had, all cash offer. So an investor. And the agent was basically saying that the investor was purchasing roughly about 200 homes a month, and he's having trouble finding inventory. And they offered cash. It's just complete cash offer. So there was a number of investors going out there, looking at the long-term situation for Phoenix. They could be anticipating a crash or collapse. And if there's a collapse in our housing market, guess what? People go and rent. And so if we have investors coming out here and purchasing our houses at cheap rates, I mean, the house I had listed was for $260, and they offered, $285 cash. How do you not take that for your client? How do you not do that? And so I see a lot of these investors coming in and purchasing these homes. And in the anticipation, I believe that there will be kind of a housing adjustment. Violet hates it when I say crash. I'm learning to use the term adjust or scale back or whatever. But anyway, I see these investors coming out and anticipating possibly a market crash out here and renting out these homes, probably at extraordinary prices. I don't know. Something to look out for in the next 2 weeks. So March 31st is the end of our eviction moratorium. That is approximately, let's see where we at. Today is the 22nd. We have about a week and a half before any of that starts. We might start seeing filings for evictions. I don't know what's impacted. I believe it's about 7%. I'll have to go back and check. But there is a significant portion of people who are renting out there that could be at risk. And hopefully not. But that's something to look out for as far as if you're looking to buy or sell. If you're looking to sell, you're still in a good situation, I believe, with the stimulus checks too. People are still making crazy offers, thinking that the government's going to, take care of them. I don't know. But right now, something to look out for is the eviction moratorium, how that's going to pan out as far as buying and selling. Selling, I don't believe you'll see any effects of that for several months. Even if the economy starts kind of falling apart a little bit, there's still going to be a number of buyers out there wanting to buy homes. The interest rate is still low. Even at 3%, it's still low. So, again, predictions, I'm just bringing information, making predictions. Talk to your real estate agent, talk to your financial planner, whatever it may be, and get information and make a more informed decision than what I'm trying to present to you. But in the long term, I believe that if you're looking for a home, you should still make your offers, still push forward. It is still a low interest rate, and in order to do that, even at 20,000-30,000 over the list price. And the unfortunate part is that you have to pay attention to those prices too, because some of these agents are listing these homes at 40,000-50,000 above what should be reasonable, and reasonable is compared to some of the other houses in the area. So if you have a good agent who is very mindful that we'll run comps prior to submitting an offer and kind of see where the house is. I've seen agents list houses at fairly reasonable, list prices, within the comp range or just above, and still people are making offers 20,000-30,000 above. But I'm also seeing listing agents that list 40,000, 50,000 above comps, and you still see agents submitting offers 40, 50,000 above that. But do not waive that appraisal. Really, I mean, sometimes we get too emotional about these things, and sometimes that you want a house or something so bad that you'll kind of lose the sense of logic behind it. Please don't offer 50, 60,000 over, and who knows, But if that's something you want to do, again, talk to your financial advisor or your real estate agent, whatever. So in the long-term sense, I believe that if you're a buyer, still kind of press forward and still make those offers. Don't go too crazy, but go as crazy as you feel comfortable with. But I will say that offering more than list price will get some attention, because there's going to be somebody else that does. Short term, if you're in it to buy it and flip it, you're taking a chance. I think there's some volatility in this market where things will kind of not go in your favor. I mean, buying a house right now, you may be able to 30 days from now turn it around for another 40, 50,000. I'm seeing that too. I'm seeing people buy houses 6 months ago and selling them again 6 months later for 30, 40,000 than what they paid. That's insanity to me. But I'm anticipating, and I'm hopeful, optimistic, that in the next 6 to 9 months we'll get a more balanced market, meaning that every offer that I make, every offer that your agent makes, will at least get some negotiation. If when you submit an offer, that you get a call back. I submitted 4 offers this weekend for different clients. Some 4 offers. And you know what I got? Okay, I was going to lie. I was going to say 0. I got 1 call back saying, thank you, I received your offer. We had multiple offers. We will consider it. That's at least a response. The rest of them, nothing. And we made good offers. I have good clients, and we made good offers. And nothing. So as today wraps up today, I appreciate your time. If you have any questions, concerns, comments, likes, loves, go ahead and drop them, because I love the loves. So Robert Morales here, Monday Market 15. I'll be signing off, and we'll be catching you guys next week for another Monday Market 15. Thursday is our unedited show with Kelsey Rognes. Tune in for that at 5 p.m. And then we also have our Finance Friday at the noon hour. So catch you guys next week. See ya.